Hello, my name is Rebecca Graham. I'm an associate consultant with Lowen Associates at IG Private Wealth Management. I hope you and your family are staying healthy and positive at this challenging time. One of the challenges we're facing is managing stress in times of uncertainty. First, we need to acknowledge the actual stress and emotions involved and assess the risk, manage what we can control, and position ourselves as best we can to deal with the things that we cannot control. During volatile times, financial uncertainty can be an added stressor. In this short presentation, we hope to alleviate some of that stress for you by sharing how we build personalized plans that address the risks to your long-term goals. These are all concepts that you've heard before, but at times like this, we feel that it's valuable to revisit fundamentals. Let's begin. As market volatility increases, it's natural that some investors want to move to more safety, hoping to avoid further losses, trying to protect themselves. But reacting to short-term market noise by making emotionally based portfolio changes can interfere with achieving your long-term goals. History shows us that by maintaining discipline and perspective during market downturns, a patient investor is often rewarded when the markets return to an upward path. We're experiencing significant volatility in the stock market as a result of this global health pandemic. In times of uncertainty, stock markets tend to decline in the short term. That's why it's so important to have a diversified investment portfolio. When you diversify globally as well as by asset class, it creates a certain amount of stability within the portfolio during times like this. Stock markets have been down upwards of 20%. However, many of our managed solutions are down a fraction of that amount. Proper portfolio construction reduces risk and provides downside protection. For the last 11 years, we've been enjoying one of the longest economic expansions and strongest bull markets in history, but you wouldn't have known it on March 9th of 2009. On that day, the S&P 500 index was down 50% from its previous high, and many people believed that capitalism had failed. Taxpayer dollars were being used to bail out the global financial system, and forecasts for the future were bleak. There was little optimism for the stock market, and it was believed that economies wouldn't grow for many years to come. Since then, investors have lived in fear of the next financial crisis. As you can see in this slide, we've endured many events that seemed at the time to be permanent barriers to future financial success. In each one of these instances, and many others, the first reaction of the stock market is to decline. But then, markets eventually rebound. In fact, over the ongoing cycle of this crisis and recovery, markets have continued to reach new highs. As this graph demonstrates, the S&P TSX has delivered an annualized return of 8.93 since 1956 and has proven to be resilient through the worst market conditions. Over the same period of time, there have been many instances when the S&P TSX declined by more than 10%. The chart illustrates that this has happened 24 times since 1959, yet each time the market recovered and achieved a higher level. Throughout history, equity markets have always experienced periods of volatility. Despite this, they'll continue to be resilient. Staying the course is extremely important during periods of volatility, as this disciplined, patient approach enables investors to fully recover from these periods and achieve their long-term investment goals. Many of the strongest market returns occur in the period immediately following a sharp decline. Since 1950, following the worst 12-month periods of performance by the S&P TSX, the market made a solid recovery 12 months later, with only one exception, and within 5 years, the markets were up significantly, meeting and exceeding long-term return expectations. In order to take advantage of those returns, it's important that investors continue focusing on a long-term plan, staying the course, remaining invested. Those who panic and exit the market, even for a short while, risk missing great opportunities when the market recovers. It's impossible to accurately time the market over the long haul, so staying invested is key. Now let's go through the 5 principles of your living plan. Number 1, using time to your advantage. Number 2, diversifying your portfolio. 3, avoiding emotional decisions. 4, maintaining a long-term focus. And 5, staying invested. Number 1, using time to your advantage. Investing for the long term is one of the best strategies for offsetting the impact of short-term market volatility. This approach will help you participate in stock market growth and achieve positive results. Financial markets can quickly move in and out of favor. For example, when stocks are rising, bonds may decline in value. Equities and other investment types may perform better in different market conditions. Staying invested ensures that you're always capitalizing on the upside of the market and reducing the impact of short-term market volatility. Although the probability of negative returns in the short term is relatively frequent, the following chart illustrates that more importantly, the possibility of earning positive returns greatly increases as the investment term lengthens. Number 2, diversify your portfolio. Deciding what to invest in can be a daunting task, whether you're a new or experienced investor. You need to be invested in a diversified multi-asset portfolio that removes the guesswork of how to successfully invest over the long term. This chart demonstrates that in many instances, the top performing asset category changes every year. As well, the asset categories that are among the best one year could be among the worst the next year, while others can remain somewhat consistent year over year. By diversifying across different asset classes and investment styles, investors can offset overall risk and increase portfolio returns by balancing exposures in both positive and negative market environments. Number 3, manage your emotional investment decisions. Using a thoughtful approach to portfolio construction will properly diversify your assets and reduce the negative effects that any individual security or asset class may have on your portfolio's performance. Financial markets don't always move in the same direction, as mentioned earlier. When stocks are rising, bonds may decline in value. Similarly, different types of equities or even investment styles are more successful in some market conditions than others. By carefully diversifying your portfolio, we can reduce your risk and enhance your chance for successfully attaining your long-term goals. Number 4, maintaining a long-term focus. Since 1948, the S&P/TSX has experienced 50 positive years compared to only 22 negative years. In other words, it's provided positive returns more than 2/3 of the time throughout history. In this chart, you'll see annual returns since 1948 plotted with their respective ranges of returns. The result is a fairly normal distribution in what is statistically referred to as a bell curve, with most returns staying within the range of 0 to 10%. In particular, note how the S&P/TSX declined by 33% in 2008, but then reversed course in 2009 with a gain of 35%. Generally, negative returns tend to be followed by positive returns, and these positive returns are typically greater than the negative returns. That's why it's so important to stay the course to achieve your long-term investment goals. All investors love the prospect of a rising stock market. But once markets decline and prices approach historical lows, many investors become defensive and retreat to the perceived security of cash or money market instruments. While nobody enjoys watching markets decline over the short term, this chart clearly demonstrates that those investors who can focus on the long term and stay invested will stand to gain. For example, an investor who remained fully invested in the S&P 500 from January 1, 1990 to December 31st of 2019 realized a 7.7% annual return, excluding dividends. Conversely, an investor who missed 50 of the best days in the S&P 500 over that same time period, and remember that's only 1% of the trading days, they realized an annual compounded return of negative 0.4%. A combination of discipline and perspective is the key to reaching your long-term investment goals. In contrast, obsessing over daily market fluctuations and short-term noise can be a surefire way to fall short of your goals. One of the ways to achieve this fine balance is by having a long-term plan and then, most importantly, sticking to it through all market conditions. While this may sound simple, recent market conditions have put investors to the test. Veering off course from a carefully thought-out plan can turn a temporary loss of confidence into a realized loss on an investment portfolio if you panic and lose your focus. Every IG Living plan is developed with a holistic viewpoint and is synchronized across all aspects of your financial life. When you have a holistic financial plan developed specifically for you with expert advice, you know when and how to act, and you can be confident in the decisions that you're making. IG Wealth Management is with you. We've tested our approach with cutting-edge predictive software, and we've partnered with leading investment managers around the globe to help us deliver results. Together, we can work on creating and maintaining the plan that's most suitable for your unique circumstances. Our team works together to produce not just good, but extraordinary results. We take coordinated action. We have the ability to move faster as market conditions dictate without losing intelligence, discipline, and focus. While we can move quickly, we do so with complete conviction and confidence. Are you still on track? It's important not to be distracted by the headlines, daily news, and constant fluctuations in the world of the stock market. Remain focused on your IG Living plan. The plan should be reviewed on a regular basis, especially during times like this, to ensure that you're on track to achieve your specific goals and dreams. Your plan will provide the clarity on how to stay focused and capitalize on any opportunities that present themselves. Your IG Living plan can be stress tested. Let me explain. When we do projections, we use average rates of return. For example, 5% compound average annual rate of return, and the software models your plan as if you were getting 5% each year, every single year. We know this isn't a reality. Some years are going to be higher, some years are going to be lower. In other words, you will experience fluctuations in returns from year to year. These fluctuations, or what we call sequences of return, can matter. We run several rigorous trials of how you could achieve the compound return you've projected and model current events like what we're going through today. This will show us the probability of your plan achieving goals depending on different market circumstances. Our focus or our goal would be to increase the probability of success over time. Over the course of our investment experience, there are only a limited number of times when major market corrections will lead to highly attractive investment opportunities, and we believe that this is likely one of those times. As legendary investor Warren Buffett has been known to say, "Be fearful when others are greedy, and greedy when others are fearful." Quite often when markets appear at their bleakest and everyone is panicking, a focused long-term investor stands to benefit the most. As we go through this difficult experience of COVID-19 and its profound impact on the global economy, things may seem overwhelming from time to time. However, we at Lowe & Associates are grateful to have the support of IG Wealth Management, of our families and our communities to help us cope with fear and stress. In turn, the support that we receive gives us the strength to continue to focus on your well-being. We believe that we're well positioned to withstand these challenging times, and I truly want you to feel confident in the rigorous planning that we have done for you and the work that we'll continue to do together to meet your long-term goals. Thank you so much for your time, and I hope that you and your loved ones stay safe and healthy.